So what is a gross rent multiplier, or GRM? Hey guys, thanks so much for tuning back in, and if you wouldn't mind taking a moment, click like on the video, hit subscribe, it really helps out the channel. So on our last video, we talked about cap rate. So today I thought we would dive into GRM, or gross rent multiplier. What is it, how do investors use it, and how can we better understand it in the investment analysis process? So what is a gross rent multiplier, or GRM? Let's start off first by taking a look at the math. So this equation is going to be taken off of two numbers: our annual scheduled gross income and our potential purchase price, or what we feel the value of our property is. So let's start off with a real simple one. Let's take $1 million property, and let's say our annual scheduled gross income, okay, this is our gross income, this is before we take any expenses out. Let's say that's $100,000. So we have $1 million property valuation over here. We have $100,000 of scheduled gross income on an annual basis. Okay, so we're going to take that $1 million property, we're going to divide it by the scheduled gross income, that $100,000, and we're going to get this number 10. What does that number 10 represent? Well, roughly it represents how many years that scheduled gross income would take to pay off the value of the property, or your purchase price. Okay, so in our case, it's going to be 10 years. So we can have a GRM high as 14, we can have it low as 8, depending on what areas you're at. Typically, we're going to see stuff in the double digits. We're going to see probably 12s and 13s, and that's kind of normal in today's market. One thing to take into account is that your scheduled gross income, your annual income, is ever changing. We're going to have vacancy, we're going to have rent increases, things like that. So this gives us a quick snapshot of where this property is right now. So this is going to help us gauge it in the market or against other investment opportunities out there. So if I have a property that has a 10 GRM and I have another property that's a 12 GRM, what is going to be the other value? Well, this is one out of many indicators, and we're going to juggle all three, but obviously just looking at GRM, that 10 is probably going to be a better value. Now, we have to take into consideration cap rates and cost per square foot and cost per units and unit mix and location, all of this stuff. But just for our example, the 10 is going to be better than the 12. So, additionally, you can even run a Performa GRM. So, if I have a 10 GRM right now, but I feel that there's some upside in those rents, what would it take me to get those rents up to market? Okay, do we have a big gap to go? Do we have a little gap to go? And what would that Performa be? So we would put together Performa annual gross income, and then we would run that against our acquisition price or our purchase price, or what we feel the value of our property would be in the market if we're looking to sell. So in short, GRM is just one of several indicators. It's a great way to look at property. Most investors look at a cap rate. I like to look at all the indicators, and we can juggle them across each other. So cost per unit, cost per square foot, cap rate, GRM, unit mix, location, those are going to be the heavy hitters right there. So I hope you guys find these videos helpful. Be sure to hit like, be sure to take a look at some of the other videos, and we'll catch you on the next one. Thanks so much.